Good morning, traders, and welcome to another day in trading paradise. My name is Charles. I come from a community called Piratetraders, where we are focused on the ES, that is the S&P 500 futures, the NQ, that is the NQ futures, and the two-way auction process. How does the market move? How do we know when it's done going up and it's ready to turn around and start coming back down? How do we know when it's done going down and ready to turn around and come right back up? Well, we use the auction process. We analyze where the market spends time, where it brings in volume, what support or resistance levels hold, and which support or resistance levels break to give us indications of what to carry forward. So before we start talking about the specifics of today's market and the levels that I'm watching and what I'm expecting at those various levels, let's zoom out for a little bit and just put into context what the market has been doing. So I'm going to start by looking at the daily candlesticks, okay, where an entire day's worth of information is smooshed into a single candlestick to sort of limit the amount of noise that we're looking at. So obviously what we can tell is that there is two sorts of balances that have been happening. There is a larger balance area that the market has been trading in. And then last week, there was a smaller balance area that the market is trading in. As far as the smaller balance area is concerned, that was balanced by pin, which we had all last week. And at the very end on Friday, we started to try to break away from that pin. But we did not know at market close on Friday, was the market going to successfully break away from that pin and start to make a move higher, or was it going to fail and pull back in? We didn't know. Well, now we know, right? We got a half an hour before the market opens, and the market has already told us it's done with this pin. At least for now, at least for this moment, it has successfully broken away. So if we're no longer focusing on this smaller balance area in here, we go back to focusing on the larger balance area. Okay. And in that regard, in the regard of thinking of, going in a larger balance area, that makes the move lower last week. I believe that was Thursday of last week. That move lower, a look below and fail of the balance area, which increases the odds that now we're heading to the opposite end of balance. Okay, so I know this seems like an oversimplification, but we were at the upper end of the balance area up here. We could not take the market higher. So what did we do? We crashed all the way down to here and eventually down to here. Okay, once we got here, we could not go any lower. So where did the market have to go? It had to turn around and go back up to that previous balance area high, but it could not go higher. So what did it have to do? It had to turn around and come back down to the balance area low, but it couldn't go lower. So what does it have to do? You guessed it. Head back up for that balance area high once again. We're going to call that somewhere around 6,100. Okay. 6,100 is that level, which is now the target for the market to the upside. Now, does that mean we're going to get there today? No, of course not. But it just means the market couldn't go lower. So what do they have to do? They have to turn around and bring it back up to look for sellers at a higher price. Okay. So the odds that we are moving up to 6,100 are now significantly higher because we were able to break away from that pin over the weekend. So, okay, great. I hear you, Charles. It sounds bullish. So do I just go long right now? Do I just smash that market buy button and just get long because the odds are over the days ahead we're heading to 6,100? No, because that is the catch of a gap. Gaps are amazing because they give us information. They tell us if the market still has momentum and how likely that momentum is to continue. But the only way we know is if we don't fill the gap. So our first order of business for the market this morning is to assume that the market wants to turn around. Sorry, I got some levels I need to clean up here. We assume that the market wants to turn around and come back down to Friday's high. Okay. That is at 59.97. That is the gap fill today. So even though getting the gap up over the weekend is bullish and it tells us this market probably wants to go higher, first it will try to turn around and go back down to 59.97. Now, gaps that are this large often don't fill on the first day. So anytime there's a gap, you have a pretty decent probability that the gap is going to fill. But as far as gap fills go, these are the least likely to happen, right? So it is still a probability that it'll fill the gap, but it's just the smallest probability you can get with a large gap like this. So odds are it will try to get to yesterday's high. If it cannot, if it finds support somewhere inside the range and turns around and starts heading higher, that is the most bullish signal we can get. That is what is called a gap and go. So the market gave us a heads up before the market opened by gapping and saying, hey, we've got momentum up. The market went on sale, gave us a dip to buy, put the market on discount so we could get an even better entry. If we don't buy that dip and the market starts to go up, we have got to get in a trade quickly, because once you have momentum, once you know momentum is in charge, the goal is to enter trades as quickly as possible. Again, this is not me making a prediction that the market is going to open and instantly start to trade higher. I'm not predicting that as the most likely outcome, but I am letting you know it is a very real, very possible outcome. This market may get one little dip and then start going straight up for hours. That is possible. Again, I'm not saying that that's what's going to happen. I'm just saying there's a good chance it could. So if that is what happens, we want to be in a trade in the direction of the gap, what we call a gap and go trade. So the first thing we're watching this morning is for a bounce somewhere inside the gap, for the market to find support somewhere inside the gap. If it finds support and it gets back above the overnight high, which is currently at 60.42, okay? If they can turn that into support, that's our next chance. So if you couldn't buy the dip because you didn't trust it, because you felt like it was going to fill the gap, that's okay. But if we get a bounce and we get above the overnight high and we get new buying up there, you definitely don't want to keep waiting around, because that is the sign that we're heading higher. Okay. And we're getting that gap and go scenario. So the first sign is we can't fill the gap. The second sign is new buying above the overnight high. Now, let's say we do get the gap fill. Let's say the market comes back down here and it gets to yesterday's high at 59.97. Okay. Well, then there's one of two things that can happen. Either the market's going to bounce there and we're going to get that momentum and we're going to go higher, or the market's going to fail and it's going to pull back down into yesterday's range. Okay. So if we get the full gap fill, what are we watching for? Do we get support here inside yesterday's range, basically above 85, right? We want to spend as little time and bring in as little volume as possible inside the previous day's range. So if we fill the gap and we just poke down into the range and then we immediately turn around and start coming back up, that's bullish, right? But if we come down and we start to spend time inside yesterday's range and it starts chopping and chopping and grinding and chopping, that is less bullish to see. Any new selling below the overnight low at 59.80, any new selling down there is bearish for a pullback into yesterday's range. Okay. So it's pretty simple as far as I see it. Highest probability in my mind today, the market tries to fill the gap, cannot, turns around and starts heading higher. Second most likely scenario, market fills the gap, bounces, starts to head higher. Third most likely scenario, or least likely, I should say, to happen would be the market fills the gap, starts to spend time, and then pulls back down into yesterday's range. One of these three scenarios, I guarantee you, is going to happen today. Either we're going to immediately get a gap and go and the market just instantly starts to go higher. We're going to fill the gap, get a bounce, and then the market starts to go higher. Or we're going to fail and we're going to pull back down into yesterday's range. Now, you're saying, well, Charles, what about just a day where we go sideways inside the gap, where we do nothing and we just go sideways all day? That is also possible, but that's not how we want to make an assumption, right? Because the gap is telling us we have momentum. There's excitement in the air. There's people desperate to get long. So we shouldn't assume it's going to get a massive gap up and then go nowhere the rest of the day. So if that happens, I'd be buying the support at the gap fill, and then I'd be looking, okay, where do I take profits as it starts to chop sideways? I guess I don't want to be in this trade. But at the time we get the bounce, I should be assuming this thing wants to make a move. Okay. Now, as far as upside and downside targets are concerned, the first target, as always, will be testing the overnight high. New buying there increases the odds of filling this gap, this unfilled gap we have above us, to 60.65. Filling that gap will probably reverse the market, and we won't get much further than that. But if we can head up to these nodes at 60.85 and 60.97. That's sort of the upper end of where I think the market could go today, if we can keep the momentum going. Any questions on any of that from the chat? Questions from the chat. Good morning to Jay, Will, Jareth, DNK, Kevin. Jay says, did anyone else lose audio? Can you guys hear me? Hello? Am I talking to myself? Jason says, let's smash the like button, pirates. Help the captain out. Yes, smashing that thumbs up button. It's one small, tiny little thing that you do. You just scroll your mouse over, you just give it a little click, click. But it really does help out for Bookmap to spread the channel, to get some new people, some new eyeballs in here. DNK says, the moment that the bigger traders are back, the low volume pin is gone. I see what you're saying. Yeah. If bigger players took all of last week off, but I wouldn't overthink it. A pin is a pin. There was some computer program somewhere that the algorithm was programmed to protect, somebody, some market maker from a big move to the downside. And so they held it and held it and held it and held it. And now the sellers are giving up and we're getting a move to 6,100. Good morning to Daniel. Welcome. Ulysses. He says, are we going to analyze the NQ? Let's do it right now. Let's look at the Q and see what it's going to do. Shibbity bop boo. Okay. Yeah. So I would say the NQ was actually kind of a step ahead of the ES last week. So the ES was balancing by going sideways in a range, whereas the NQ had a channel to the downside. Let me just update this real quick. Yeah. So the NQ had this channel. This was the momentum down. So pretty much all of Friday, continuing to build momentum up and build momentum up and build momentum up, was giving you the head start that the balance was over, right? That we were no longer chopping in a range, that now the market was ready to make its next move. So I was actually more bullish on the NQ at the end of the day on Friday and more uncertain on the ES. So how do we carry that forward today? Well, if we know the balance is over, right, we should expect excess. So yesterday, Friday's range would have been the first day of excess. Higher highs, higher lows, value higher. The gap up is the next sign of excess. And the last sign would be a gap and go. So exactly the same as the ES. The question we're asking ourselves is, when the market opens, can they stay above, we'll call it 21,550. Can they stay above that area around yesterday's high? If they flip and turn around anywhere inside of there, it's bullish. The first target is testing the overnight high and then monitoring for continuation higher from there. The overnight high is around 21,760. Okay? So if they find support anywhere above 21,550, assume they're going to 21,760. Okay? If they get back into yesterday's range and they start to spend time and bring in volume, that's where you start to get bearish. And the first target to the downside is a test of the overnight low, monitoring for continuation lower from there. Okay? But exactly the same as the ES, I would say the higher probability is that the market wants to go higher today. It broke out of balance. It got its first day of momentum. No reason it can't get a couple more days after that. Okay? So both markets, it's all about the gap. All about that gap, about that gap, about that gap. Okay? It's all about what happens when the opening bell rings. We expect the market to go down a little bit, right? We expect the market to try to fill the gaps. So we're not bearish if the market starts to go down first thing in the morning, because we know that's just overnight traders that are net long, taking profits. That's just, shorts that are looking for a gap fill, getting short, trying to target a move to yesterday's range. We know that. That's not real bearishness in the market. The breakout, the momentum, the gap up, that is real bullishness in the market. That is true momentum up. So the bears are the ones that have to convince us they're going to take control today. They would have to get all the way to the gap fill and get new selling inside yesterday's range, both markets, before we even begin to get bearish. And if you're saying, well, Charles, I'm looking at the ES right now, it's, a 25-point move from where the market is currently sitting to the gap fill. To me, going down 25 points would be bearish. Well, then I say to you, you and I trade on different time frames. Yes, it might be bearish on the 5-minute candle for the first half an hour of the day or whatever. It might be a little bit bearish for a first move to the downside. But if you're thinking bigger picture, would you rather be getting short, hoping it's going to fill the gap, or waiting to see the support on a gap fill and then getting long for the bigger move to the upside? You can make just as much money going long as you can going short if they buy the dip, right? Which is the higher probability. So don't force trades first thing in the morning unless the market immediately gets momentum up, in which case you have to force trades because you just got to get in. Any other questions from the chat? Any questions? It has begun. The world reacts to something that Trump says. Then Trump comes out and says, "That's not what I said." Oh boy, get ready for the next 4 years, y'all. Market makes a 40-point move to the upside. Oh my God, something bullish. Nope, just kidding. It's not really bullish. Market crashes right back down. Oh my God, he says something negative about China. The world comes to an end. The market crashes 50 points. He comes out, no, didn't mean that. Market bounces once again. 2025 is going to be a fun year for intraday traders. Lots of chaos, lots of opportunity. Good morning to Grizzly Bull. Welcome to you. Griff is here. Jason in the house. Trevor. Oh boy. Good morning, Buccaneers. James says, Fed Governor Cook says Fed can proceed more cautiously in cutting rates. Risk to inflation and employment are roughly in balance. Well, thank you for the update, James, but I don't think about that stuff at all. Everybody's got to have their own way they make sense of the randomness of the market. Make no mistake, the market is random. It is random. I will argue this point until the cows come home. Okay? Everything the market does every day is always totally random. It is just a reaction to whatever is priced in. And you never know what's going to be priced in, and you never know what the reaction is going to be. So it's a push and pull between those two mechanisms. So when something happens macro-wise, the Fed says something or changes rates, or, the president says something, or a major corporation says something, or whatever, yes, the market might be volatile. It might react to that news, but using the news to guess how the market's going to react will never work. Never, ever, ever. It will always be random. So the way I choose to approach markets is I just ignore all the fundamentals. I ignore everything except for one single thing. Where does the market go? How much time does it spend there? And how much volume does it bring in? If all you pay attention to is where does price go, how much time and how much volume, you can be right about what's coming next a majority of the time. Always? No. You can never always be right. But you can be right way more than you're wrong. Whereas if you try to use fundamental information, this person from the Fed said that, or this, whatever. If you start to try to use fundamental information like that, you can be wrong 90% of the time. And those guys usually are. If you pay attention to the talking heads on CNBC and stuff like that come out and make predictions based on fundamentals, they're probably wrong about 70 to 80% of the time. I mean, they're just always wrong. And then they always come out and say something like, this is a shock. I never would have expected this to happen. But it's like, yeah, but you said that last week, and you said that the week before, and you said that the month before that. You're just always shocked that these things are happening. Well, stop paying attention to it. Stop worrying about it and just focus on price. Is the market going up? Is it going down? When it goes up, do more participants want to buy it or less? That's all you need to know. And then you'll know where the chart is going to go. So that's my spiel on fundamental information. James, you had no idea you were walking into that. You thought you were just being nice. You thought, I'm just posting something. He'll like this. And then I pounced. But that's, of course, because I'm in teaching mode right now. Today is the beginning of the workshop, Mastery of Markets and Minds. I'm going to be teaching everything I know about trading, all in depth over the next 2 weeks. And so I got to pay attention to every little comment that's made to share all the information I possibly can. And I'm in teaching mode right now because the workshop starts today at 11 a.m. If you have not signed up yet, you might consider going to marketsandmind.com. Scrolling on down, looking at what you would learn if you signed up for the course. Yes, I'm going to teach you how to read a chart. I'm going to teach you how the auction process works. I'm going to teach you how to predict what the market is going to do before it does it based on what it's doing right now. But I'm also going to teach you the skills of being a trader, learning to separate self-understanding and market understanding, honing your intuition. When should you listen to that little voice in your head? And when should you tell it to shut the F up? Because that's not what the market generated information says. And teach you how to think in probabilities and manage your risk so that you can never blow up another portfolio again, so that you can always protect yourself from the downside risk. Okay. I teach all of that and more starting today. If you're interested, just click on that Mastery of Markets and Minds image, add that sucker to your cart and check on out. And I will make sure that you get the email before we start the first lesson today at 11 a.m. I hope to see you all there. If not, no worries. I'll do another one in 6 months. You can just lose money for the next 6 months and then sign up then. I'm fine with that too. All right, guys, 4 minutes till market open. Any final questions for me? Anything you want to know? Anything at all? Oh boy says, hoist the anchor, rig the sails, catch the tide, and set the course. Ahoy! Yeah, all of those things, guys. Let's get ready to trade. I've said it once. I'll say it 1,000 times. Sometimes when the market opens, the best thing you can do is just sit back, relax, and wait for more information before you enter trades. Gap and go is not that day. If we get a gap and go today, you got to be ready to trade in the direction of the gap as soon as you feel confident it's a gap and go. Because if you wait around too long, you might miss it. So the first order business is to try to fill the gap, to try to get back down to 59.97. You don't have to jump into a long right at the opening bell. But if they can't get to 97, you might be saying to yourself, where am I going to get long? What will convince me to get long? And if they get to 97 and they bounce there, same question. You only want to be thinking about shorts if we get new selling below 97. In my humble opinion. Ain't nothing better for a trader than momentum. Two minutes to market open. 2 minutes to paradise. DNK says, how do you decide to take the short for the gap fill? Do you take the trade at the open or wait for it to hit resistance? It's a great question. So if I'm going for a gap fill trade, it's never the second the market opens. It's when the market can't go higher. So let's say the market opens right here and it starts to try to go higher. And it can't. It's starting to get resistance. I would then put a stop sell order at the opening price so that if it comes back down through the opening price, that's where I get short. At that point, the market starts to move lower. My stop is above whatever was the high, before it crossed back through the opening price. Once it gets to a half gap fill, so once it's about halfway to being filled, I will then take that stop and move it below my entry, usually about a point below my entry, because there's a fair odds that the market will reverse at a half gap fill. And so obviously I don't want to lose money if that happens. If they fill half the gap, I don't want them to come all the way back up and take me out for a loss. So I'll move my stop below my entry, but I do still want to be in the trade in case we get the full gap fill. Anytime I'm in a gap fill trade, 100% of the time, my take profit is a point above the gap fill. It's never exactly at the gap fill, and it's certainly never below. Because again, sometimes they'll fuck with you and they'll reverse, generally only for a few minutes, but they will reverse literally right 1 point above a gap fill and then freak the whole market out. And you don't want to get shaken out if that happens. So I'll just lock in those profits a point above a gap fill and then look for what's next. And if we get more selling, and we start to stay inside the previous day's range, I look to short for continued lower. If we bounce and we start to come back up, I look to get long again. Or I look to get long for the first time, It's important to note, I am not always in a gap fill trade, and the time I'm least likely to enter a gap fill trade is a day like today, where it has a large gap. And I know that seems strange because you're like, well, if it's a large gap, that's where you can make a lot of money, but the large gaps are the least likely to fill. So if I'm trading based on probabilities, I'd rather be buying a dip when there's a large gap than trying to short for the gap, if that makes sense. But anyway, let's find out. Market is open. We will find out what comes next literally right now. Okay, so this is that scenario where if I was going to go short, I'd have a sell in right here with my stop above here, and it'd be getting filled right now. Oops. There we go. All right, this is the gap and go. They tried to fill the gap. If they were going to get the gap fill right then and there, they should have gotten continuation lower. So this is the first bullish or the second bullish, gap up being first, gap and go second bullish signal. Remember, we get a lot of gap and chops nowadays, which means it goes up and down through the opening price a dozen times. So all we're doing is just stacking pieces of information right now, stacking the odds. Okay, the gap up meant the odds are the market's going higher today. Okay, the immediate gap and go increases the odds of that. But let's let them chop a little bit and we'll keep adding up those odds in our mind. Okay, here's the test of the overnight high. Again, this is the next level where we find out what comes next. If we look above the overnight high and we fail, pulling back down through the opening price now, it significantly increases the odds they will try to fill the gap. If they hold this as support and they stay above the opening price, that is as bullish as it gets for continuation to the upside. Can the buyers hold the open? So we got an iceberg at the low. I'm not going to pay any attention to it right now because we have momentum up. And so momentum is my focus, not weakness. An untested iceberg is basically the same as a weak reference, and it's right at the low. Okay. So that's a reason for the market to come back through, but I'm not going to pay attention to it as long as we're above the opening price because we have momentum. It's very important to distinguish between the two. Is a signal you're getting a signal of momentum, or is it a signal of a need for balance? If it is a signal for a need for balance, it doesn't matter until the momentum runs out. Then it becomes important. Okay, moment of truth, dancing on the opening price. Can they hold it? Okay, they cannot. Passing back to the opening price, ticks breaking the zero line. We got an iceberg, so you know what that means. Now they're going for the gap fill. Again, I'm not bearish on this at all. I think they're just looking for buyers. So we are expecting a dip now down towards 60.17, but I suspect there'll be buyers there for a bounce. Willie T in the house, good morning to you. Daniel says, is that all the liquidity on the map, or is there more if you were more zoomed out? Yeah, so it's just always, if you're looking at the heat map for Bookmap, it's always showing you relative to whatever is on screen. So right now, because I'm zoomed in between 60.17 and 60.55, it's showing me the liquidity between those two levels, and how like dark it is, the color of it is based just on what's within those levels. So like right now, 60.42 looks like a fuck ton of liquidity because it's dark red, right? But if I zoom way out and change the context, it's less. You see what I'm saying? Because now I'm looking at everything between 6,000 and 60.50. So it changes how dark it is. But yes, whatever you're seeing on screen, the colors are based on within that range. Where is the most liquidity? And so obviously you can guess from me telling you that I'm not really worried about liquidity way above or below price right now. I'm focused on what's literally right around price, which is why I'm so zoomed in. Because when you open with a gap up and you get a gap and chop, which is what this is, where we cross through it a bunch of times, the market is deciding right now what it wants to do. It is either going to gap and go, and we're going to get a move to the upside, or it's going to come back down and fill the gap. And so I'm watching to see how they're using liquidity to try to, manipulate the market, to try to get it to do what they want. Right now, obviously, it looks like they want to move to the upside because there's way more liquidity above than below. Still feels like a gap and chop to me. Especially if that iceberg. Yeah, see, so now, like I said, at first we were ignoring this iceberg because we were holding above the opening price. But since then, we've crossed the opening price a couple of times. So this is in play. This iceberg matters. Another thing that's catching my eye right now, each big move to the upside is taking out a lot of stops. A lot of the buyers that we're getting up here at the highs is actually sellers getting squeezed. So we want to start to see those new buyers in order to trust it's going to keep going. All right, we have new buyers at the high. That is bullish. Once again, it's a gap and go. So the first target to the upside is a test of 52, 60, 52 for resistance, and monitoring for continuation higher from there. So when we talk about the two-way auction process and how it affects price, it's always a matter of, can we bring in new buyers, right? If the market goes higher, are there people that are going to go long because the market went higher or not? The other side of that coin is when you get a bunch of people to go long at a higher price, if the market doesn't keep going, what happens to all those traders? They get squeezed. So the market did its job. It did not fill the gap on an attempt to fill the gap. It literally barely went in a few ticks. So that's the first step of the buyers being in charge. The next step is they were able to get above the overnight high and they were able to bring in new buyers above the overnight high. That is step two to buyers being in charge. Both of those things tell us the higher probability is that the market wants to go up. But now they have to stay above the opening price because now all this activity, look at where all the volume is for today. Almost all of it is above the opening price, barely anything below that. So if the market comes back through the opening price now, they're going to squeeze all these buyers. And that's going to lead to a bit more of a dip, a stronger dip the next time around. So if the buyers want this gap and go momentum, which they have, if they want it to keep going, they've got to keep price above the opening and they got to keep the momentum. They got to push it as far as they're going to right now. So that is why I say bullish above the opening price, chop/gap fill below. I will lose all my bullishness instantly if we pass back through that opening price. But as of now, the buyers are saying we don't need to. We can convince people to be long just by getting above the overnight high and forcing them to chase. And chase they are. Jareth says, Captain, how do you know they are new buyers? What showed the info? Okay, that's a great question. So in a literal term, it was the ticks that caught my eye this time around, but it's also just a logic-based thing, right? If the market goes up and it gets above the overnight high, this is an area where traders will take profits just every day, no matter what's happening. The overnight high is a place where traders take profits, right? Any traders that got long in the overnight, they're going to start taking profits there because by that point, they're all in the green, right? If you got long anywhere inside the overnight range, once you get above that high, you're in the green. And that's when people start taking profits as soon as they can. So that's a great place for the market to run out of steam. It's a great place for a market to get above an overnight high and then come right back down. And so what I'm looking for when I get there, and there's a bunch of these levels, which I teach in the workshop today, but what I'm basically watching for is what happens when we get there. The first thing is time. When we get there, do we spend time? Do we kind of start to go sideways up there? And sometimes this is literally like 30 seconds. It doesn't take a lot of time for me to recognize, okay, we're spending time. You know what I mean? It's just like it got up there and it didn't come back down. It stayed. So if I'm spending time, that's a sign that there's business happening. Because if we poked up there and there was no one willing to do business, guess what price would do? Come right back down, right? It would just instantly reverse. So if it pokes up there and it stays up there, someone's doing something. Someone's exchanging contracts. Now, they could be more of them going short than long. That is possible, but somebody is doing some kind of business up there. So there's two ways to figure out what that business is. You can either wait and see which way price goes. And if from that moment where it's going sideways, it pops higher, you know it was more new buyers. Or if it pops lower, you know it was more new sellers. Another way is you can look at the market internals, in particular the ticks, the tick chart, TICK. This is showing you the amount of stocks that are going up versus down in the NYSE. So if more of the stocks are going up, right? If there's more, stocks going up a tick than down a tick at that moment where the market's going sideways, guess what's probably happening? Buyers, right? People are buying the market. They're now chasing price. And so for me, that's what it was. I was watching the price spend time right there at the overnight high. And then I went to look over at the ticks. They were like right here. And then they went boop a little bit higher. And I went, yep, those are buyers. But they got to the first potential resistance area. So now it's going to be more work. They got to come back down. They got to hold this support for the next poke. Let's see if they can keep it going. The buyers are in charge. They have the momentum. How far can they push it? Well, we'll just have to wait and see. I was also looking at the Bookmap and finding it very, very interesting the way they keep piling on more liquidity above. This is one of those things that tends to happen when a market has momentum to the upside. You'll notice big pools of liquidity above price keep getting added as price moves higher and higher. Whereas if you start to see a lot more liquidity below price, they're trying to bring that momentum to an end and bring it back down. So if you just look at the liquidity here, you can see, whoops. 1 second. Darn it. There we go. You can just see they're adding more. 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 Oh, look at that. Now they're starting to pull it. So now they're ready to let the market dip. All right. And then if they start adding again, if this starts to get dark yellow again, guess what? They're coming back up for it. If instead stuff down here starts to turn dark yellow, well, then that was probably the high of the day, and we're about to pull back and fill the gap. All of these are just little hints. They're little pieces of information. My brain processes this information in a fraction of a second, and I just feel, okay, it's bullish. Okay, it's bearish. Oh, no, it's running out of steam. So first you got to learn what all the levels are, what to look for, and then you have to put in the screen time and just stare at the chart over and over again and learn to kind of understand what it's doing. Okay, so now what are you noticing about those liquidity nodes above I was talking about? They were fading off the liquidity. And price started to go down. Now what are they doing? They're bringing it back. So they're telling price, no, we want one more poke to the upside. RJ says, worthy insights and info rendered. You're welcome. Happy to render. Okay, so the live stream is going to be coming to an end here in about 4 minutes. We are expecting a little volatility with some numbers being released. Somebody mentioned in the chat earlier. So what am I expecting moving forward here? Well, it feels to me like the market wants to fill the old gap up at 60.63. Okay, so that's actually the gap above us, not the gap below us. We have a gap on both sides of us now. That's the old gap from last month, from the 26th. It feels like the market wants to fill that gap. I'm not convinced they're going to get much beyond that. Okay? The buyers are having to work very, very hard here to poke up into this resistance. And so that tells me that there is profits being taken, in between 50 and 63. So I don't think the market, as of now, as of the information I have in front of me right now, I don't think the market's going to make much of a move beyond that, beyond 63. However, if we get up there and we get new buying, then we assume that momentum can continue much higher. But my assumption is we're going to get a few pokes into this and then run out of steam and come back for the gap below. That's the way it's feeling right now. And again, I can't predict the future. I can just take whatever's happening at this moment and use it to predict what will happen over the next half an hour. So I can't really make a prediction for what's going to happen the rest of the day, but that's as close to a prediction as I can get. So I would say for sure, stay bullish above the opening price because those buyers want to get up and fill that gap. If we cross the opening price, the momentum is probably over for the day, and we're probably going sideways from there inside the gap. But for now, the bulls remain in charge. Nor Auto Trading in the house. He says, can we look at gold? Sure. Let's look at the shiny metal. Oh boy. Yikes. All right. Well, that is a market that is in balance. Looks like for a couple of months here, basically since mid-September, that market is just going sideways in a range. Yeah, I would say trend line down from the highs, trend line up from the lows, breaking that triangle. That's pretty much what you're looking for to be able to trust it. Yeah, that right there. So that's what I'd be watching on gold. Assume it's going to continue to bounce inside this range and get tighter. And then whichever way it breaks on these trend lines, you're looking for it to break out, come back down, turn it into support, or break lower, come back up, turn it into resistance. That's where I would trust a bigger move in gold. But it's gold, so it'll go sideways sometimes for years before it finally starts to break some way. So patience on the shiny metal. On a shorter time frame, it does seem like it has a channel, and it is now heading up towards the upper end of that channel. If you're looking at just like the last week. Oops. Like that right there. You know, tested the low, turning around, heading back for the high. But bigger picture, it's still in balance. Daniel says, I see a lot of liquidity above, but what I believe to be delta is going lower. Yeah, so you're running out of buyers, right? But you still have them. That's the point. And that's the thing about momentum. As long as you have momentum, the market will keep going in the direction of the momentum. So if you have momentum up, as long as there's still someone willing to go long at the high, the price will keep going up. But yes, if you're starting to see more sellers, each time it pokes up, more sellers, more sellers, more sellers, guess what's happening? You're running out of buyers, right? A lot of those buyers are taking profits, turning them into sellers. And so it's probably not going to keep going forever when you start to see that. But this is what I tell people when it comes to momentum. I'm going to be talking about this tomorrow in the workshop. Or sorry, 2 days from now in the workshop. I'm going to be covering this in detail. You got to think about momentum like a speeding train, okay? A train is on its tracks. It's going full steam ahead. That's what momentum is. A train does not just instantly stop and reverse and start going the other way. It has to slow down first. So it's like going really fast. It has to come to a stop, and then it has to start to power up the other direction. Right? So of course, there is such thing as a V-shaped recovery. That's another conversation. But generally speaking, a market is not going to go straight up and then turn around and go straight down and then turn around and go straight up and then turn around and go straight down. It's going to roll over. It'll go up and then it'll slow down. It'll go sideways for a little bit and then it'll start coming down. This is where the magic exists. If you can recognize the moment where it stops balancing, it stops going sideways and it starts the momentum, you can get short for the momentum. If you recognize where that momentum starts to run out, you can take profits on your short. And then when you recognize it start to break higher again, you can go long. That's what trading the auction process is. So even if you're seeing a change in the delta where you're starting to see more sellers coming in, it doesn't mean it's done going up, right? This may just be a dip and there may be another dip and it might keep going up. But it's a sign it's starting to roll over. It's starting to run out of steam. That is why I say I think we're going to get the gap fill to 60.63, but I don't necessarily think we're going to get much beyond it. I think there's going to be a lot of profit taking in here by the longs. And so slowly but surely, they will start to roll over and run out of steam. And then later on in the day, whenever we cross through this opening price, then you get a liquidation. The market starts to liquidate lower. But not yet, because right now we still have buyers. We still have people doing business at the high. And as long as they keep doing it, it will shock you how far they can push it. With that, unfortunately, I must say goodbye to everyone. We got 150 people hanging out, but we only have, drum roll, 49 likes. There's got to be at least half of you that liked this live stream today, but didn't push the thumbs up button. Let's get those likes smashed. Let's smash them on in. And if you're a member of the brigade, the Piratetraders Brigade, costs $20 a month to join. If you are in the brigade, head on over to the private stream and I will see you there in about 5 minutes. And if you have been thinking that you want to learn this stuff, the course costs $450, but that's not that hard to make back if you trade the ES. A gap and go this morning could have already got you up by at least 3 or 4 points. Okay? That's already enough to pay off half the course in the first morning. And this thing's probably got another, 5 or 6 points to the upside from here, another 10 points even. So if you can learn the skills that are needed to trade, you can make all the money necessary from trading to pay off the education that you took on to learn. But if you don't learn those initial skills, you just tread water for years. You win some, you lose some, you feel like you're figuring it out, then you feel like you're lost, and you just end up on this endless cycle of trying to figure markets out. What my course does is it teaches you how to get off that cycle, that endless cycle of going nowhere, and start going in the right direction, which will lead to much more success. So if you've been thinking about signing up for the workshop, head to Markets and Mind, markets plural, and mind.com, and sign up now. Course starts in an hour. You want to be there or be square. All right. Happy trading, everyone. Next week is going to be in the Discord for the Bookmap stream. So I won't be here on the public channel. So you're going to have to be a member of the Discord for Bookmap if you want to hang out next week. But the week after that, I'll be right here. Thanks a lot. Bye.